Good afternoon, ladies and gents. Investors often say the three virtues of a great enterprise are CPG, which are consistency, profitability, and growth potential. Here, as Team 4, we introduce you to the firm that captures all the three, CJ Korea Express. We suggest a buy recommendation with a target price of 251,000 won, granting us 35% upside from its closing price on December 9th this year. As the market-leading logistics provider in Korea, CJKX boasts its annual revenue of 5 trillion won with 4% OPM and 1% NPM. Its revenue is earned by three divisions, CL, Parcel, and Global. Before moving on, we can understand the business model of each division through this simple simulation. Global division manages cross-border transportation in and out of Korea. CL now takes charge of stevedoring and warehousing of these materials, safely delivering them to B2B clients. The finished goods are delivered to consumers by Parcel division or exported by Global division.
Now on to our investment points. First is the CL division, which has and will provide the firm with consistency. The CL division handles company land freight with high competitive edge. The main source of its superiority comes from the 80-year history of operation in Korea. During such long time, Korea Express has built a nationwide spectrum of clients and items, as well as warehousing capacity that is several-fold the size of its peers. With its longest householder position, the CL division has been able to gain a stable growth of 5% CAGR with a constant OP margin above 5%. We're confident that this stability will be sustained given two main factors. One is the secure growth of the 3PL industry. The constant increasing trend of 3PL coverage is expected to benefit the CL division as it generates 80% of revenue from 3PL operations. The other factor is the mix change in sales figures. Up to now, CL enjoyed rapid growth of consumer packaged goods revenue due to increased online grocery shopping. Increased CPG sales is estimated by 9% CAGR.
Our second point is Parcel division, which would bring profitability to the firm. Merger with CJGS was a milestone for Parcel division for its speedy market share growth up to half of the market. The main reason behind this success is higher degree of agglomeration. Since CJKX handles 3 times the demand of others, its CJ delivery man just needs to cover 1/3 of the area to fill 1 quota. This comparison shows such operation efficiency leading to its superiority of service in speed, reliability, and hospitality. Parcel industry is expected to keep amassing in size as mobile shopping grows. With this rising quantity, we expect CJKX to secure more than 1 billion box sales by 2020. Price-wise, the industry's average price has constantly fallen as competition got fierce. But as there are only few winners left that form oligopolistic market, we expect prices are to rise back soon. This shows price and cost spread per box of CJKX, trend of which would continue till 2018. From then, however, due to dual effect of price rise and cost reduction, the spread will start widening. Such spread will boost up the firm's operating profit, mounting up to 225 billion won in 2020.
Our last investment point is global division that will stretch the firm's growth potential. Let's take a look at CJ Group's core business region. 70% of its global sales come from Asia, with the 3 main businesses all successfully rooted. And as an affiliate of the group, CJKX's global network is also centered around China and the ASEAN. And such focus is getting even sharper as the firm added 28 branches in China and 7 in the ASEAN this year. More worth noting is that the firm is actually taking aggressive expansion move through M&A investments. Except a humble acquisition of a small Chinese firm in 2013, there was no further M&A for the next 2 years. However, only for this year, the company has already announced 3 mega deals by acquiring 2 firms from China and 1 from Malaysia. This M&A move proves to be highly effective as it brings 3 attractive synergies. Firstly, the acquired firms will simply widen the range of business in those areas. Secondly, they will add both local firms and MNCs from the third countries as clients, contributing to the future expandability of the business. Lastly, Adding market network on top of advanced capabilities will bring full-fledged growth on the business potential. Therefore, we expect the division sales to amount up to 3 trillion Korean won by 2020. In short, 3 investment points show that CJKX will enjoy the ultimate CPG assembly of consistency, profitability, and growth potential. And now on to the financial analysis. 3 main points to be heeded are reliable cash flow generation, improved margins, and strong financial flexibility. We can start with the cash flow. The firm's cash flow was very fluctuant during the merger period. It was because the merger with CJGLS caused a temporary CF inflow drop from operations, as well as incurring the related cost burdens. However, we expect this volatility to be significantly stabilized thanks to organic EBITDA growth and working capital increase, as well as healthy capex cycle. They will prevent the free cash flow from dropping onto its risky level.
The second point is improved profitability. Originally, CL division alone contributed for more than half of the firm's profit. But as the margin trend shows, the other 2 divisions are showing signals to be more profitable. The rise of 2 divisions will not only balance the firm's CL-reliant portfolio, but also lead to improvement in ROE, ROA. Asset increase will be steady with 4% CAGR, but asset turnover that exceeds such increase will double ROA by 2020. ROA increase will be twice as higher, up to 8% by the same period.
The third point is financial flexibility, shown by ratios of 2 areas. Firstly, liquidity will start to stabilize with current quick ratios laying over 1.0. Secondly, profit explosion will put aside the interest risk, especially shown by ratios of especially shown by tripling of the interest coverage ratio. The firm's strong credit profile adds to its financial flexibility, shown as AA rating by Korean Credit Bank, which is expected to hold or be upgraded by the next bond issuing. The constantly lowering bond rate also provides favorable condition, enabling the firm to practice greater financial flexibility for further aggressive investment.
Now on to valuation. We have used DCF analysis for CL and Parcel division and PE analysis for Global division, coming up with 224,000 and 27,000 won respectively. Conclusively, as the SOTP of those 2, we initiate the target price of 251,000 won with 35% upside potential. For DCF analysis, under these assumptions, we resulted in 4.6% as total WACC. With 1% as terminal growth rate, we arrive at the fair price of 224,000 won per share. As for PE analysis, we have selected 30 global firms as peer candidates. After strictly applying 3 exclusion factors, we are left with DSB, Expeditor, and Nagel as our peers. After applying PR adjustment, we average them to draw out 15.3 as our target PR. Multiplying that with our forward EPS made us arrive at the target price of 27,000 won per share.
Finally, the risk analysis. Our team analyzed total 7 risks of 4 categories that may cause change and enterprise value. Of all, 2 risks have been assessed as major threats to the firm. The first risk of KX is the owner's health disorder. The owner, Jay Lee, has practiced strong influence on group expansion through M&As. His sickness may impede the expansion of CJKX. The other major risk is Lotte Group's ambition for logistics industry. This retail dinosaur may look for a second target after acquiring Hyundai Logistics this year. It may be a threat to CJKX's parcel price increase scenario.
In order to reflect sensitivities, we have conducted 100,000 simulations of Monte Carlo. As a result, we are given 54% of buy recommendation. To conclude, due to CPG, which are consistency, profitability, and growth potential, we initiate the target price of 251,000 won with 35% upside potential. Thanks for listening.
maybe let me start with the multi-color simulation that you mentioned. And when you run multi-color simulations, typically you pick a few variables that are very important for the company, and you give different scenarios, probably using random numbers to use different paths to come with that distribution. And can you tell us a bit about what variables you've used for running the multi-color simulation?
So may I confirm the question as to be asking for the main variables that we took into account?
Yes. First, Monte-Carlo simulation is a computational algorithm that relies on the repeating random sampling. So we use a random samples of those things. First, we reflect earning difference and risk-free rate, beta, cost of debt, and market risk, and multiple. As seeing those things, we set the earning as a bull case and bear case, which is reflect the loss of the economic differences. And for the risk-free rate, we using the Euromonitor's forecast. Euromonitor forecast suggests the top line and bottom line of the future interest rates. So we consider about those things. So we set the bottom and top of the risk-free rate. For beta is the statistical variable that is derived from the regression analysis. So beta has a standard deviation. So we reflect the beta standard deviation. And COD is as same as a risk-free rate, so we set the variability of the COD is using the Euromonitor forecast. And market risk is we consider the stagnation of the cost piece growth. Nowadays, for 6 years, cost piece shows a parallel movement, so we apply the stagnation of the cost piece, so we set the market risks downwards. And multiple sets we set our peer companies, so for them, we apply their variability of the PER. So that's how it is how we adjust the multi-color simulations.
Okay, and one question on deriving target price of 27,001 using multiples of comparable companies. So here it says, I believe this is your forecast EPS for 2017 of 1,765 won, and you derive target price of 27,000 using target PE multiple of 15.3. However, if I look at page 3, it seems you're saying, well, forward PE, using forward PE of 22.5 and current, your target price of 251,000, that gives earnings of more than 10,000 Korean won. And if we use close price of 178,500 won, that gives you still very probably earnings of 6,000 or 7,000 won EPS. So what am I missing here?
So the PE, the target PE that you're seeing on this page 3 is the PE that would be applied considering the forward EPS of the total company, but our valuation was fairly based on the SOTP analysis. So the target price of 27,000 as our target price is just for the global division, which is basically based on the overseas branches and support operations there.
Add on to that, nowadays forward P is at 22.5. It's a little bit higher than our target PER, but considering the PEG, which is the price earning ratio to the EPS growth, compared to our peers, we expected CJKX has expected more increasing EPS growth. So that's why we think our target PER is conservative.
Thanks for the presentation. The one thing that seemed to be missing was a discussion of competition in the competitors. I didn't see any analysis of how this company's either their profitability or really anything compares against the competitive set. Why was that not part of your discussion?
We would like to discuss the competition and the appendix. Therefore, we will introduce our competitors in parcel division, which are Hanjin Express and Hyundai Logistics mainly. The competitiveness above their peers, CJKX have the higher degree of agglomeration, which directly related to the economies of scale effect. Therefore, CJKX could have a higher speed and efficiency and best service quality, which was shown in the recording that it had been ranked in first place for 5 years in terms of the customer satisfaction index survey. Therefore, Hanjin is now suffering from the financial aggravation due to its holdings, due to its group problems, and Hyundai Logistics now has been acquired by Lotte Logistics.
And adding on to that question, we would like to introduce some 3 reasons that we can, because there seems to be some doubt about the possibility of a price increase scenario in the industry. Is it correct?
Yeah, that's actually my follow-up question.
Yes. So we have come up with 3 reasons. The first reason is that industry had been suffering so much from the chicken game, and the competitors, it was really obvious that the competitors were really suffering from the low profitability and margin due to that. And since there are now few winners left, because the market is highly consolidated, we were very confident that competitors were really eager to re-rise their price back to their profit margin. The second reason was that there was low sensitivity.
There was a low sensitivity of price increase, and we actually did survey on perception of price increase in Korea. What we found was that customers actually think the parcel price in Korea are fairly low, and even though there is an increase in price, they were willing to keep using the delivery service. Therefore, we assume that 5% increase in price is fairly appropriate. The last and foremost point is the CJKX strategy. The firm aims to increase the price naturally by providing the premium service, which is 1 day 2 cycle delivery service, and by after the completion of Gunjim terminal. In sum, the service mix change will boost up the price increase naturally.
And behind our rationale, why we are emphasizing the competition in the parcel industry is one of the core parts during this company. So we conducted some case studies to deal with the price increase scenario and deal with the competition problem, and we found that the first case is the dairy industry, and after the merger of Elpida into Micron, the overall operating margin in the industry has significantly rise. And as the CJ case, CJ as one affiliate of the CJ Group has shared some kind of similar strategy to Korea Logistics. And after acquiring its market rating position, it has successfully raised its price from 6,000 to 8,000. And as Korea Express has already successfully secured its market rating position, we expected the price increase scenario. And the final case was we consider was the Japan case. The parcel industry of Japan and Korea, there is some similarity in that the top 3 companies are taking most of the market shares. The top 3 companies of Japan has 90% of its market share, and they agreed on the price increase in 2013. And as viewed on the right side, the top 3 companies' market share is now 70%.
And to shortly add on that, lastly, the reason why I thought we thought competitors were really eager to rise back their price was because there were some signals. Korea Post and Hyundai Logistics have risen the price actually 2 years earlier, and also the Coupon has raised its standard fare for free delivery service. So that means that competitors are really suffering from low margin and profitability.
So you've got Coupon, you've got the potential further entry of e-commerce players, you've got Shinsuke Lotte acquiring distribution. What's the risk that the long hoped for price rises, which are the market thesis, which is why the stock trades at higher multiples, what's the risk they're never realized?
So to clarify that, may I clarify that?
Yeah.
So
Time's up.
yeah.